talk about Bajaj Auto, but right now let me just capture the market, and the market rates are Wednesday morning, brand new month and a brand new day. But it's the status quo in terms of trend. The breadth is powerful. Small and mid-cap indices are off to a good start. And Bajaj Auto, is it immediately reacting to the numbers? Let's capture that. Of course it is, and it will. It is, and it will more. Because these are bravo set of numbers. Now these are numbers which are the company dispatch. So is the company building up inventory in anticipation of a strong festival season demand? That's one. Or B, there is an extraordinary uptick which has come in largely because of some sudden demand which has come somewhere. I don't know. We'll try and get details, but right now markets are reacting to those numbers. Meanwhile, just when we thought that markets will be off for a flat start, comes the selling. The breadth is holding on. But what has gone down in the Nifty? Let's look at it actually. I think it's L&T, it would be Reliance, it would be HDFC Bank, the combination of typical IT and heavyweights which really is leading the market. So Reliance is down, HDFC Bank is not going anywhere, ICICI Bank is not going anywhere, and banks is this, cross. I mean, it is like a, it's like a mill in the neck of the bulls that you cannot run and you cannot walk with this FI selling in the financials, and that in a sense is the real impediment for the bulls to really launch any kind of an attack. But so far market breadth is holding on, and the benchmark indices are trading with a narrow negative bias.
Bharti and L&T, those are the two stocks that you may want to look out for given the earnings reaction. Of course, it's been an above estimate on all parameters. Management pretty optimistic on the guidance. Order inflow for L&T, 1.6% higher for L&T as we speak. And Bharti is the one which will come up for you on your screens because that's where the disappointment has been. 1.7% lower. It's almost a seesaw of sorts between L&T and Bharti this morning. Tata Consumer as well has been a good set. The numbers are above estimates on all counts. Lupin, they received an EIR from US FDA for their manufacturing unit 2 in Mandideep. Lupin holding up 1% as we speak. Ather has come out with decent numbers. The profits have risen almost about 35%. That will just come up for you on your screens. Motherson Wiring, the EBITDA jump up of 37%. Ather has gapped up 4%. Motherson Sumi Wiring 2.5% higher. CE Infosystems has come out with its numbers. Thyrocare Tech is come out with its numbers. There's been a decent margin expansion to 25.3%. MRPL, wherein there is EBITDA jump up of about almost 3.5% there. This KEI Industries, EBITDA up 27%, margins at 10.5%. So all these stocks are reacting positively to their numbers. What is JSW Energy up to, considering Prashad Jain has stepped down as the joint MD and CEO of the company with effect from Jan 31st next year? Not a big knee-jerk reaction, 1% low on JSW Energy. In fact, it's only strengthening from there, rebounding from there. Mankind came out with its numbers. The margins are flat on a sequential basis, and the revenues have seen an uptick of 11.6%. A big gap down on that stock to begin with, 3.5% lower. GSPL also came out with its numbers. The numbers fell short of market expectations. The standalone EBITDA per ton is below the estimates. It's come in at 11,164 per ton. Jindal Steel is seeing JSPL, I beg your pardon, that's down about almost 5% as we speak right now. DCB also came out with its numbers. Asset quality has deteriorated. There's Keynes Technology as well. Gross margins contracted 200 basis points. And then Star Health, wherein the net premium earned was up about 15%. And the combined ratio has risen 130 basis points, but that's not quite on course with what the market was anticipating. Star Health down 1.5% as we speak right now. Other disappointments have been Thampu Sugar. The EBITDA is down significantly, almost 29%. And Naveen Fluorine as well, wherein the EBITDA margins is the lowest in about 18 quarters. Naresh, what's looking good to trade right now?
So continue to like the space of exchanges and depositories. So CDSL is one which has broken out. A buy on current levels as well as on dips.
Okay, Ashwini Agarwal joins us now. Let's connect with him and let's say hello to him to understand what his market and market take is. Ashwini, good morning. Thank you for joining us.
Morning, Nikunj.
Ashwini, there seems to be a sudden pause, or I would say the feeling of uneasy calm in the market. Do you think we've hit a peak for next couple of months, not days and weeks?
Yeah, I think so. I think, Nikunj, the way I would describe the market is that it's not too hot, not too cold. I definitely don't see the room for the market to take out the previous or recent highs. Downside is probably limited to another 5% on Nifty at worst, because the domestic investment sentiment is still pretty strong, notwithstanding the news flow from overseas, including high interest rates as well as what's going on in the Middle East. So for the domestic sentiment to break, you will need a lot more negative news or some sort of a shock that is unanticipated as of now, or a significant worsening of what's going on in the Middle East. And at the same time, on the upside, you don't really have the support from foreign portfolio investment flows to take out the recent highs. And the IPO activity has picked up a lot as well. So that's kind of putting some pressure in terms of where the funds can go. So if you take all of this into account, my sense is that the domestic sentiment will not allow the market to sink a lot unless the domestic sentiment caves in for some reason. And there's not much room for upside either.
Ashwini, everybody is saying that be overweight on India. India is the place where you want to be and you want to invest more. But if I look at the FI selling, it's at a record high. The FNO positioning, again, record shorts. So why are our fair feather friends who've always been India, who've backed us during tough times, suddenly taking such a stepmotherly treatment when the India appeal is perhaps the best in the world?
So, Nikunj, I'm going to be guessing here, right? So there are a couple of things. One is when global economic environment is looking extremely fragile. There is a tendency for investors to exhibit home bias. So if you have large funds, which are stationed out of the United States and across the board, emerging markets as an asset category has been losing its relevance because all the large emerging markets are kind of, fallen one by one. In that context, I think that, increase in home bias is somewhat palpable. The second thing is that, when you look at foreign portfolio inflows, you have to look at, there are different types and different categories of investors. So you have sovereigns, which is long-term stable capital. You have long-only, India-only funds, which is also relatively stable pool of capital. And then you have asset allocators and global funds. So, and then finally, you have the proprietary desks and hedge funds. So it's the last two categories or three categories where the fund flows tend to be a little volatile, and they tend to take a look at short-term, outlook and trade accordingly. So, the FI numbers being volatile is a function of, these several types of players. And I would say that there are pools of capital within the foreign portfolio inflows that are not necessarily driven by long-term economic outlook.
Interesting. Ashwini, hi, morning. So what's the best way to make or rather benefit from this domestic risk appetite, which will hopefully keep India afloat?
So, it's bottom up. Okay, I know it's a often repeated phase and it's probably beaten to death, but I would say that the correction that we've seen in the last month or so has seen several stocks give up nearly 15-20%. Also, there are bargains available where sudden sentiment change has resulted in short-term price movement. So I think those are the places to look. I continue to be reasonably positive on financials and pharmaceuticals in particular. And for those exporters that got punished because of high raw material prices as well as high transportation costs. So all of those abnormalities which resulted from COVID are now firmly behind us. So, where you find a combination of fundamentals plus some price correction, I think bottom-up investing is the only way to go. I think, my initial comments to Nikunj are more pertaining to the Nifty, where one doesn't see a lot of downside, one doesn't see a lot of upside. But I think on individual stock basis, there will still be opportunities that one can benefit from, especially if the price action has been negative and the fundamentals are intact.
But since we can't talk individual stocks, thematically, does it seem like, it's the usual suspects, IT, chemicals, etc., where you do see value, some of the underperforming banks?
Not so much IT, to be honest, because I think IT, I'm getting very confusing signals. I mean, net hiring is down for the first time in 25 years. There's a lot of stuff going on there. So there are individual companies there that might be an opportunity, but I think on a more macro basis, I wouldn't want to invest into IT right now. I've been waiting for IT literally for 6 months, watching every quarter. And every quarter I heave a sigh of relief once the quarter is over that I didn't buy. So IT I would like to stay out of. Chemicals, there are different players. There are upstream and there are downstream. The upstream players, I think, will continue to face pressure because they benefited a lot during the COVID period because of very high prices for basic products and intermediate products. And I think the downstream chemicals that kind of buy base chemicals or buy intermediates to make finished formulations, those are the ones that suffered over the last 2 years, and that's where an opportunity is there. So I think chemicals is also I would say I would look at company specific and where we see raw material costs easing off. That's where an opportunity might lie. In financials, yes, financials I think look very interesting, and I would still be stock specific, but I think here there's an opportunity to buy both the large caps as well as the mid caps selectively.
Hi, morning. Earlier we were just talking about how the earnings season, is, despite all that's going on, has comparatively been pretty strong across the board. A lot of reports are indicating that profit growth has been witnessed, and this is across sectors. What do you believe this is indicative of, and how are you looking at the overall earnings season transpiring over the next coming quarters? Will the resilience, especially into the festive season, etc., continue?
So my thoughts are that the earnings season has multiple drivers to it this time around. On one hand, you have softening raw material prices and softening transportation costs feeding into the margins. On the other, you have financials which are benefiting a lot from low credit costs. So those are two broad themes. There is some revival in consumer demand, but consumers are witnessing a continuation of the K-shaped recovery that we saw during COVID. So urban demand, especially the high-end urban demand, is doing extremely well. I think on the rural side or semi-urban side, I don't think there is that much recovery. Going forward over the next 2 quarters, I do think that softer outlook for global growth will feed through to India via exports. So I don't think we can sit back and relax in terms of earnings outlook. And I think some of the base effects will also fade away. Base effects in the sense that lower credit costs for the banks or lower raw material and transportation costs for some of the downstream chemical companies that I spoke about earlier. Some of those base effects will fade away. So my sense is that over the next 2 quarters, I would expect slightly slower economic growth and slightly slower earnings growth. Mind you, overall corporate health, financially speaking, is still very strong. There's not much leverage in the system. Government expenditure continues to be very strong. There are signs of corporate capex picking up. So all of that is there. But I think on a sequential basis, you will see some slowdown over the next couple of quarters.
Well, Ashwini, season's greetings. Really appreciate your time and certainly hope to see much more of you going forward. Thank you for joining us.
Thank you, Nikhil.
Markets, what do we have? I mean, in this market, if you don't deliver, you have no space to hide. And I think Star Health really has been a casualty. It's a stock where you would say first COVID hit them. Then they're looking at changing their model from corporate insurance to retail insurance. But cost combined ratio, which is what you look at insurance companies, which is that the money which you get upfront when you're selling an insurance policy and the expenses what you have in terms of commission and others, is that less than 100. Now, if it is more than 100, it means that you're getting 100 rupees and you're spending 101 rupees, which means you're actually losing money. But if it's less than 100, that means you're actually making money by selling insurance policy. Which means you're not just living off the treasury income and the float. Unfortunate case of Star Health, the CD combined ratio has gone up by 130 bips. I really hope it's a temporary phenomenon, because if the combined ratio deteriorates more, then the stock is going to get jammed. But one company which is firing full cylinders and they have managed to beat which is a rarity in this current environment, is Tata Consumer. So let's take a conversation forward on what is the secret sauce for Tata Consumer for the quarter gone by, and is the worst in terms of margin and in terms of the environment is that behind us. Sunil D'Souza joins us, Managing Director and CEO at Tata Consumer. Sunil, good morning. Thank you for joining us. These numbers are good, solid, and they deserve a table, thumping applaud. It's a rarity to, it's a rarity when we say that FMCG companies are beating estimates. So how have you managed to beat the peers and analyst estimates?
So Nikunj, always nice to talk to you, and thanks for the compliments. I do think we've delivered a decent set of numbers. Just to highlight, top line was up 11, EBITDA was up 30%. Group net profit, we did say a -7, but if I offset the one-time land sale that was there last year, net of exceptionals, we're up by 24%. EBITDA is up 220 bips. We're seeing volume growth across all the businesses. Growth businesses in India are firing at 40, international is up 13. Gross margins across all businesses, more or less where they should be, bar the US where we've got a little bit of work to do. Financial numbers, our working capital is down by about 2 days. Cash flow conversion is up 100 bips, and we remain on track to deliver 95 to 100% of EBITDA to cash for the full year. ROC, which is you have kept mentioning as our bugbear, we're up by 210 bips. Hopefully that trajectory continues, even on the strategic front. And I think that is the key to delivering good numbers, staying focused on the strategic pieces, staying focused on the basics and executing them well. We have outlets at 3.8 million. We had said split routes in all 1 million plus towns. Most of it is complete. We've got direct distributors in all 50,000 plus towns. That is complete. So outlets up to 3.8 million. A&P, we've upped the game in India. We're now close to 7. Costs, huge focus on them. Just as a perspective, manpower costs, we're getting leverage of top line now. On other overheads, 3 years back, we were 15% of sales. Now we're down to 8.5. Working capital India from 50 days where we started 3 years back, we're now down to 23. Innovation, we had guided for 5. We are now at 5.5. Premiumization working very well. Salt, for example, premium salts delivered 64% growth. They're now up to 10% of our portfolio. Beverages, again, the premium portfolio doing better. So Nikunj, all in all, a decent quarter. And I think the key has been focusing on the strategic priorities and executing them well.
Look at your growth businesses, Sampann, Soulful, Nourishco, Smart Foods. They are growing at 39%. That's the data with us. Smart Foods grow 39%, Sampann 47%, Nourishco 25% plus. These are good numbers. That's a high growth which is kicking in. But the core of Tata Consumer is still the tea business. And in the tea business, you are losing market share. You lost market share and some market share has been chipped off. So while the growth businesses are contributing, the mainstay, which is the tea business, if you lose market share, will they just equalize each other?
So Nikunj, I would just make a couple of points there. We are en route to becoming a total FMCG company and not only a tea and salt company, as I put it, and therefore the focus on the growth businesses, which are doing well. Now, coming specifically to tea and salt, let me just put the market shares in perspective. We had huge amount of volatility on the tea prices, and therefore, as prices of tea come down, normally the local players play a little bit more in the market. But that said, while you will see on a MAT basis a little bit of bleed on share, but quarter to quarter it is now stable. And I remain confident that now that we've got our infrastructure almost fully in place, we've still got to build out some rural distributors and powering it with A&P, I think we'll be in a good place to start getting the trajectory up. Quarter on quarter, now the shares are stable. On salt again, while you will see a little bit of dip on salt market share, just to put it in perspective, last year we were the first off the cuff taking price up, and therefore we gained value share mathematically. But as the other players came up on pricing, the whole value table has lifted, and therefore it's a relative term. But just as a perspective, September came in at a 38 share, which is a 12-month high. So the trajectory has already started moving up. Incidentally, when we started 3 years back, we were at a 30 share. So we remain confident that both the businesses, we're seeing volume growth. Tea is 3%, total foods is 6% growth. So we remain confident that we will get market share back.
the portfolio of Tata Consumer into two: tea and salt, the traditional business, everything else, the new high growth business. What kind of total revenue split which you have from the traditional business and from the new business? And since you are creating these new businesses right now, which is the FMCG business, the oil business, the packaged food businesses, right now, do you think the aggregate margins for the high growth businesses would be lower?
Yeah, so you're right, Nikunj. The aggregate margins for the high growth businesses are slightly lower than the sum total. But just to put it in perspective, broadly, ready to drink and Soulful are in the ballpark. It is Sampann which is slightly lower, but Sampann, as we get scale, as we build out procurement efficiencies, as well as do product differentiation on the front end, they will start coming up. But just to put it in perspective, whether it is Sampann, whether it is Soulful, whether it is RTD, we don't have capex investments, and therefore, from a return on capital perspective, these are phenomenal businesses. So high growth, high ROCE, slightly lower margin, but margin is work in process and it is trending upwards.
Sunil, I'm just curious to ask, what's been your observation at a time when we've all grappled with an uptick in food inflation? Any consumer trend that you can tell us about?
So, three things out here. I think basically, if you see tea volume growth, we said is 3%. It should be in the 5% range. Now, it's good news and bad news. A year back, we were in negative territory. We have come back into positive territory, but we are still not where we should be. So that's one piece. Second, if you look at rural overall, I think there was stress. Inflation was impacting the rural consumer. And on top of that, sporadic monsoon did not help. Manrega numbers, if you look at it, were trending upwards. But recent times, we do see things improving. If I look at one indicator, which I always look at, is two-wheeler sales have started to come back. So that is a good sign from a rural economy perspective. So all in all, I do think we are coming out of the slump. And I think we had said that in January of 2023, that is, we had said that we are starting to see a complete slowdown. And we are seeing an upward trend from here on, and that's what we are seeing. But for Tata Consumer itself, I keep telling the team, focus on what you can control. Make sure that you're executing to the T, because even if there is softness, as long as you're executing, expanding distribution, focusing on market share, when the trend starts moving up, you'll be in a fantastic position.
In continuation with that, while I get your premium brands have done way better than the economy brands, what about out-of-home consumption trends? How's Starbucks footfalls been?
So overall, Starbucks, we are now in we have 370 stores. We have 49 cities where we are present. We've accelerated the store opening. We are now, last quarter, we opened about 24 stores. From that perspective, we are doing well on Starbucks. There has been a bit of slowdown on growth. It is not in negative territory. Overall, there's been a bit of slowdown in growth. But you have to remember, there has been a shift in the festival season. So I wouldn't read too much into it. I do expect that the out-of-home industry, especially coffee, will continue to be on upward trajectory. I think the ball is in our court as to how fast we can expand our footprint.
Morning, Mr. D'Souza. I also wanted to talk a little bit about your outlook in the international markets and which category you believe is going to lead growth here.
So international, I think, came to the party big time this quarter. Overall top line was 13% ahead of the total numbers. I would say we've got different fixes for different markets. Canada, where we are market leaders, we're on a very strong footing. There, the game is now to expand the portfolio, and that's work in progress. In the UK, we've always maintained that while we were good or we were decent in the black tea, the growth was in the fruit and herbals and specialty segments. The good news is we focused on it with the Good Earth and Teapigs brands. We're getting more listings, we're getting more distribution, the brands are doing well, and now we've got in September, we've got a 10% share of fruit and herbals. Overall, while we have close to a 20% share in black tea, Fruit and herbals, we were coming from behind. So that has been strong, number one. Number two is we've always said we've got opportunity to expand portfolio. So we've taken Soulful to the UK. We had to relabel it as Joyful because someone else had the Soulful name there. And we are listed in about 400 plus Tesco stores and doing very, very well. Same thing, we're getting very good reactions when we are approaching retailers in the US and Canada as well. US market was a bit of up and down with coffee prices now trending down steeply, and therefore a bit of discounting in the trade, which we've got to react to. But we're very confident. We put in actions into place, and we're confident that that will come back as well. We've always maintained that the international business, after we've right-sized the cost structures and focused on the growth drivers of basically tea, coffee, and now expanding portfolio with cereals, etc. EBITDA margin should be accretive to our total business, and that's the target.
I have the Morgan Stanley report in front of me. It talks about the ROE percentage. It was at 7 when we first started asking you about the ROE and how it is increasing. And it is estimated to go, according to Morgan Stanley, to 11 or 12 in 3 years. Will Morgan Stanley get it right?
I would hope to beat Morgan Stanley, Nikunj, simply because you're absolutely right, and that's what I maintain. And that's what I quoted. ROCE, which is another perspective, we're up by 210 bips versus the same quarter last year. That is a huge focus to make sure that we leverage what we have, continue to drive the top line, holding costs constant. If you look at all other parameters, Tata Consumer is up there. This is one we are maniacally focused on.
It is literally the case when it comes to Tata Consumer. There is always a gap between lip and a sip, because you missed the Bisleri acquisition by just a whisker. Now that would have been a big acquisition, and that in a sense would have really added a lot of capacity, would have given you different kind of a presence. Now that the acquisition is not going through, in terms of an appetite to acquire, how will that change? When I speak to some of your counterparts, and I'm not talking about FMCG counterparts, some of the peer CEOs of Tata companies, they are saying the following, that the repair work is over, the growth and the acquisition mode has started. Is that true for you?
I wouldn't comment about other FMCG companies or other Tata companies, Nikunj, but all I can say is we have always maintained that Tata Consumer, we want to build a large FMCG business, both organically and inorganically. Just as a perspective, we're sitting with 2,500 crores of cash. Inorganic is something which we are scoping on a constant basis. The whole idea is once you build the back end with the logistics, warehousing, etc., and you build the distribution system, we've got 4,500 salespeople and 3,500 distributors now. Now the pipeline is all there. Now it's a question of what else can you pump through the pipeline. The critical piece is to make sure that the expansion of the portfolio, especially inorganic, is value creating. It is incremental in portfolio, it's incremental in margins, and gives us more clout in the trade.
So as you expand and build your current high growth businesses, when do you think the J curve really will come for the company? Because right now you're in growth and expansion phase. 2 to 3 years, you will be able to build some of these brands bigger, maybe gain market share or create these new categories. So when will the large benefits of that start kicking in? FY25, FY26, FY27?
So Nikunj, I would say with most of the infrastructure laid out, most of the capabilities we've already invested behind the capabilities, whether it is digital, R&D, back end, we've got shared services going. Now the cost lines are pretty much stable. There's not going to be too much expansion on fixed costs going forward. So therefore, it's all a question of top line margins thereof flowing to the bottom line. And I would expect starting FY25 onwards, starting to see the real benefits coming. We remain extremely conscious that while I did comment saying that we've improved our EBITDA margins by 210 bips, we're still behind some of the FMCG market leaders. So we've actually benchmarked where we want to be every year. So you would start seeing FY25 onwards acceleration coming.
Benchmark Nestle, HUL, or perhaps Britannia?
I would say the whole FMCG universe. We've got every single company laid out, and we know who's at what level. They range from about 17.5%, 18% up to 25. I don't think we're going to get to 25 very quickly, but one piece at a time.
So how soon before you'll go to 17? Let's look at the lower part of the benchmark.
In EBITDA margins, I would say in the next 24 months or so, 18 to 24 months, we should be at that level, Nikunj.
Yeah, that, I can see the packaging of gulab jamun at the back. So is that the Diwali surprise from Tata Consumer this time? No rasgulla, no laddu, but gulab jamun.
So just as a perspective, Nikunj, one of the categories in which we had not actually focused on, we needed to revive out there, was our mixes. And when we look at the mixes space, one of the large spaces which we are not playing is in the sweet mixes. We were playing in the rava, dosa, all those kind of mixes, chila mixes, etc. But the dessert mixes is a huge portion, and it is very seasonal. So about 2 months back is when we've launched it, and we do hope to have a good festive season.
Well, so wonderful to have you on ET Now. Season's greetings from everyone from ET Now. All I can say is that it's just been such a classic turnaround for Tata Consumer that it's just been an honor tracking it, and every quarter we interact with you, you delightfully surprise us. So festival greetings, and next time we meet, hopefully it will be rasgulla, laddu and gulab jamun, all three.
Thank you, Nikunj. Always a pleasure talking to you and the team. Thank you.
Let's take a break on that festive note. Tata Consumer 905, but when we come back, well, we are talking 5-star. No, not the chocolate, the company. They've also come out with good set of numbers.
Back with first trades, let's just revisit what the first trades have settled in at. What looked like a quiet start with L&T doing the magic, but Bharti a drag on the other end. We're absolutely flat for the day so far. Idea has pushed up some more. DLF is holding up 3.5%. Birla Soft is looking good. Indiabulls Housing and Vedanta are some of the names which are perking up quite nicely. There's also Hero MotoCorp, Bajaj Auto. They're all also holding out quite smartly in trade. But 5-star, that's actually come out with a quarter which had all 5 stars in tow. So let's chat a little bit about what the future visibility is like with the CFO. We've got Shrikant Gopalakrishnan joining in on the show right now. Shrikant, hi, good morning. Good to have you on the show. Excellent set of numbers with, be it your AUM or for that matter, disbursements. But early in the first quarter, you had upped your AUM growth guidance to 35%. What are your expectations now with regards to second half? Would you have to up the guidance further?
So first of all, a very good morning and thank you for having me on the show again. It's always a pleasure to connect, especially after a very good set of results. We did up our guidance to about 35% plus, post the first quarter results, because we were seeing very strong traction on the field. As you said, on the disbursements, our numbers are really picking up. The demand is showing up extremely well. The COVID clouds are behind us. So people are today coming back to, better incomes, which means the requirement of their credit is also getting that much more. So I think we are seeing very strong traction. If you look at year-on-year growth, we were at about 43-44%. But at this point of time, we are not looking at revisiting our guidance. We are still, going with a 35% plus growth, because the base is also slightly higher as we move, quarter on quarter. We expect to be, better than our guidance. But for now, our guidance stands at 35% plus, which we are very confident of achieving, having seen the demand for the last couple of quarters on the field.
The other thing, right? Because as your base becomes higher, sustaining that kind of growth rate would be challenging. Just suffice to say that at 35% you will plateau for a while?
So our belief is that, it's going to stay on for maybe another couple of years at least, because one is, there has also been some pent-up demand. So if you look at our growth rates in FY21 and FY22, we just grew about 14%, which is almost like a flat kind of a growth. So because we were also a little wary in terms of how the cash flows of the customers are going to stack up. But what we are seeing is, yes, our belief in this customer segment stands vindicated. They have been extremely resilient. They are back to very strong business momentum now, which is why we upped our growth guidance. So I think with the pent-up demand and our ability to penetrate, for example, one of the very important metrics that we have done during this quarter is putting up 70 branches. In fact, it's an all-time high in a quarter. So each of these branches are going to become profitable, going to become going to contribute to the growth of the company. So I would think it's not going to plateau in the near future, but maybe over 3 to 5 years, I think this number will start graduating, more in a more measured manner. But for the next couple of years, we are confident of at least about 35% kind of a growth coming through. So typically, we have been guiding the market till FY26. Our guidance still stands.
I would imagine that the second half, because of the business you are in, will be better than first half. At least that is something we should imagine.
You are right, Nikunj. The second half is always better. Not from an NBFC perspective, the last quarter always tends to be the best. So you will definitely some kicker coming through, but it will not be, significantly different from September, because typically, the September quarter tends to be, relatively as good as the fourth quarter. So you can expect some positive impact in the last quarter. But I would probably say that, it's not going to be significantly material. What will be material is the new branches that we have put in. Given that, we put 70 branches, and each of these branches typically takes about 4 to 6 months for them to break even and start contributing to the growth of the company. I think we should see good momentum coming from these branches in Q4.
Right. The other thing that I wanted to talk about, Shrikant, was also your margins. Because what one has seen is they got a little impacted by that lower yield. Your borrowing costs, as I see it, decline about 10 basis points on a sequential basis. And you're also increasing leverage on your balance sheet. You mentioned this as well in the past. What's the NIM's trajectory that one can expect then going forward?
Again, this is something that we've been talking. It's also going to be gradual. Given our strong yields, and one of the points that I've been talking to all of you, and one concern that probably was there on our heads is how the entire cost of funds is going to stack up. Extremely happy to say that we have been showing benefit on the cost of funds on a quarter-on-quarter basis, but again, that is definitely going to plateau or maybe increase a little bit when some of the borrowings come up for MCLR resets and all that. But our yields are stable. If you look at, we've always been operating around the 24 to 24 quarter kind of an yield. So which means even if our borrowing cost goes up a little bit from here onwards, we're still looking at a 13-14% kind of a spread. But at some point of time, like we have, even talked to you, we would want to pass on some of these benefits of the reduced cost of funds to our borrowers. So in a steady state, and I would probably put that again at around 3 to 5 years kind of a time frame, we should be looking at a steady state spreads of about 12 to 13% and NIMs of about 14 to 15%. Today, both are probably higher by about 150 to 200 bits.
What about your asset quality? Because that's managed to hold up even well in tough times like, COVID, and has seen an improvement, so on and so forth. But what's the case going forward now? Because you are getting into higher ticket sizes as well. You think you'll be able to maintain your asset quality?
So firstly, I would like to just correct a fact that you said we are not actually increasing the ticket sizes for the sake of increasing ticket sizes. We have just gone back to our pre-COVID levels. So if you look at pre-COVID, we were at about 3.5 lakhs. But during COVID, being a conservative company, very conscious strategy to lower our LTVs, lower the debt burden ratios, and also be a lot more conservative in our estimation of the customers' incomes. We actually brought down the ticket sizes all the way about to 2.5 lakhs. Today, we have just gone back there. So we really don't see any asset quality issues coming on account of the ticket size increase. The second point is, like I said a little while back, I think we really stand vindicated in our belief about the resilience of this borrower segment. So we have always been saying that this is a borrower segment that does not get significantly impacted by macro up cycles or down cycles, or even if they get impacted, they're probably last to get impacted and the first to bounce back. And that is something that we're actually seeing. In fact, if you just go back about 2-3 quarters, when the entire new norms of NPA recognition as per the IRAC norms were getting implemented, we had sort of guided the market that the difference between our 90 plus, purely from a DPD perspective, and the revised norms will be 75 to 100 basis points. But what we are actually seeing, it's only about 30 basis points. While again, we are not revising the guidance, we'll have to still see a little more time. But we are definitely very confident about the asset quality, to sort of hold around the 1.5% levels and our credit cost to stay at around 75 to 80 basis points, which is something that, any NBFC business should be prepared for. And given our yields and NIMs that we are talking about, we are extremely comfortable with those kind of numbers. So at this point, absolutely no alarms. The execution excellence is actually getting reflected in the asset quality. In fact, three parameters that we actually look at, quality, profitability, and growth in the same order. We will continue to look at it in the same manner. So never are we going to put growth or profitability over quality. So quality will always remain on top for 5-star.
I have to talk about the foreign ownership as well in your business, which stands at about 50% stake. There's been a recent PE exit as well, 8.5% stake. Do you expect more such exits?
I was hoping at least this question will not come in this interview, given the stellar set of results that we have delivered. But yeah, see, that's something like what we have been, talking to you. PEs have their, time horizon. They will have to, keep selling at points of time. What we again say is that, and like how the 8.5% block deal happened, we will definitely ensure that it happens in a very coordinated manner. The good part is nobody is in a tearing hurry to sell. Even if you look at the last 8.5% deal, Matrix Partners that came in about 8 years back, they're still continuing to be shareholders on the cap table of the company. So nobody is in a tearing hurry to sell. But yes, we will see some blocks coming at points of time. Hopefully it will be more distanced rather than coming at quicker intervals. And given that people are also seeing the compounding benefit accruing to them, we are hopeful that they'll stay on for a little more time. But we believe that there are good backers for us. In fact, if you look at our the 8.5% sale that happened, very strong names like HDFC Mutual Fund and all picked up a big part of the stake. So today there are backers who are definitely confident about the business model of the company. So we don't really see any impact coming through, even if there are going to be blocks that will come in. Blocks will come in, but it will be ensured that it happens in a very coordinated manner so that both the buyers and the sellers don't stand to lose.
What about Sequoia? And I'm purely asking this specific name here because Sequoia is a compulsion because they're unwinding their book and they're a large investor. So I may like the business, but if I have a redemption happening back home and if my schemes have an issue, I may be able to sell it. And that is an overhang which everybody talks about. Sequoia, and when will they exit and what will happen to their stake?
So Nikunj, I think my answer still stands what I gave you last time. You're right to some extent. Sequoia had invested in the company through multiple funds, through their Asian funds and also their US funds. The stress what they probably saw was in the US funds, and I'm happy to say that a couple of the US funds which had about 1.5% or close to 2% stake have completely sold off their stake. So today we are not looking at pressure coming in from the Asian funds or the Indian funds of Sequoia. So the bigger overhang that probably was there because of the internal pressures of Sequoia have largely settled. So I think I would probably put Sequoia today in a bucket which is similar to any of the other PEs. So we are not seeing any internal stress of Sequoia potentially impacting their ability to hold or them offloading the shares in the market. So we're not unduly worried about it. The one or two names that were there, the funds which were US based, they have completely sold and exited. So I think from that perspective, the overhang is largely off our back.
When will it become 7-star? For 7-star, you'll have to grow at 40%. For 7-star, you'll have to up your guidance. So when will we get 7-star numbers from 5-star?
So I don't know what the 7-star numbers that you're talking about, but our belief, like I said, is that we want to be one of the market leaders in this segment in lending to small business loans. We are guiding the market for a 35% kind of a CAGR for the next 3 years at least, and thereafter it will have to start graduating. We are also, hearing, regulators being very happy about the business model of the company. But at the end of the day, there are other murmurs also happening in the economy in terms of unsecured loans being picking up and all that. So I think we will have to sort of balance the interests of the market, the shareholders, and the other stakeholders like regulator. But at this moment, Nikunj, we are extremely confident. The business model is stacking up very well. Demand is completely back. Asset quality is holding up well. In fact, one of the metrics that I'm sure you would have looked at is not just in terms of the NPA numbers, in terms of the DPD numbers. If you look at a 30 plus portfolio, that has dropped sequentially by about 110 basis points. So we are at about 8.6%. The current portfolio is at an all-time high of about 86.5%. We are expecting this number to touch to about 90% in the next 2 to 3 quarters. So all the elements of the business are in place. I wouldn't be surprised if we surprise you by becoming a 7-star or, more than a 7-star company sooner than later.
Yeah, that. And on that high note, thank you for joining us. Season's greetings, and so nice to have you back again on ET Now.
Thank you. Happy Diwali to all of you.
We've got a new listing today, Blue Jet Healthcare, and the new listing on your screen, 392. These days, 3 days it takes for a company to go hit the IPO market and get listed. I mean, just so fantastic what SEBI and what the systems are now. There used to be a time when it would take weeks, 3 to 4 weeks, and by that time market would turn. And when you have a listing for 3 days, what happens is that you don't end up taking a lot of market risk. I mean, imagine if a war-like situation happened, what happened last year. By the time the company goes public and by the time it lists, everything changes in terms of where the market is. So that I think is a big change in terms of how things are. Okay, Suresh Magnani joins us now, Executive Director and CEO with ATGL. Suresh, good morning. Thank you for joining us. Okay, Suresh, good quarterly numbers. What are the drivers driving this earnings season? What are the factors which will continue for the balance part of the year?
Thank you. Thank you for inviting Adani Total Gas once again on your channel. I think the key drivers to bring the healthy outcomes physically and financially has been our mandate from both promoters, Adani Group as well as Total Energies, to continuously enhance the reach of infrastructure. And if you see the way we have been enhancing both PNG and CNG infrastructure to the large masses of customers, that's one critical factor driver. Second is certainly the recent, effective April 23, we saw the gas pricing reforms both for APM as well as for HTHP domestic gas. And that enabled us to promptly reduce our prices and make the PNG and CNG affordable for the consumers. And the third, which comes from a DNA of both promoters, Adani Group and Total Energies, is our eye on digitalization, robotization, automation, and operational excellence. These three factors have combinedly enhanced the volume for this quarter, 20% year-on-year basis for CNG, and overall PNG and CNG volumes have grown up by 10% if you see on year-on basis. So these have been the key drivers for our healthy outcome of physical numbers as well as the financial numbers.
Gas price trends, because as winter is approaching, you may actually see some tightening.
You see, gas prices gets decided or keeps moving up and down based on several factors, geopolitics, the storage status with various European and other countries. So certainly in the winter is one of the factors where the gas prices starts getting upward. The good development is that India now over the last couple of quarters have been enhancing the domestic HTHP gas, and that has enabled us to build the portfolio. So from while winter would see some sort of a tightening of the gas prices on the RLNG front, but on a domestic side, since there is an APM and the HTHP gas pricing reforms are in place, we would be in a position to provide competitive and affordable gas to a large number of our consumers.
What are your infra and capex plan going forward, considering that you're one of the largest player in the CGD industry, and at large that commitment needs to be fulfilled?
It's a very good question. As we have been stating in even the previous quarters, that our stated capex is that we will be investing 15 to 20,000 crore over the period of 8 to 10 years. The key target for us is taking the 500 CNG stations to cross more than 1,100 stations in the near future. Almost 800,000 customers, we have to grow to 3 million in the near future. And similarly, there will be a significant growth in our backbone steel and MDP pipelines. So we have, as I have been saying, that robust capital management and allocation policy in place, and we expect to run rate of 1,500 to 2,000 crore per annum in the next few years.
Now, when we spoke to you last time, you said that you were looking at building 3,000 to 3,500 EV stations. How many have you managed to build?
So, I'm very happy to inform you that we incorporated a few months back the e-mobility SPV within Adani Total Gas. And within short span of a time, we have been able to establish 221 charging points across 64 locations in 9 states. And as I'm speaking to you, almost 600 more charging points are at a very different stage of development. Many are going to be getting energized once we get the DISCOM connectivity. And the good part is that we also have a healthy pipeline on the acquisition of a new locations. So we are on our target to set up 3,000 charging stations in the near future across pan-India basis. And the target is that we grow our charging points across the format of B2B. We are adding several B2B business partners, B2C, so that public can come and charge their vehicles and their strategic location. And also our intent is to create e-mobility hubs across the country.
On the bio business, you've awarded a municipal solid waste building plant. How important is this? I mean, do you think this is a business which you can really scale up, especially in terms of managing bio business or city waste?
You see, this is one of the most critical nation building agenda. We are currently third or fourth in the generating the municipal solid waste in the world. Around 61 million tons of a municipal solid waste is getting generated, and the way lifestyles are changing, hopefully we would be number one in generating the municipal solid waste. So and since there is a technology available to convert this municipal solid waste to the CBG or several other products. So we have taken a decision that we would be exploring opportunities to help the municipalities across the country and convert this waste, which is completely getting dumped across our cities, to the CBG. And recently in this quarter, Q2, which is the result we announced, we are happy to announce you that we have won 500 tons per day MSW, municipal solid waste contract from Ahmedabad Municipal Corporation. And all the work is going on currently for developing this project. And we are looking forward for many more such opportunities across the country. Besides municipal solid waste, our SPV on biomass is also looking for non-MSW based development of the biomass project. And as your viewers are aware that Adani Total Gas is currently building India's largest 600 tons per day agri and cattle dung based CBG project in Barsana near Uttar Pradesh, and we are hoping that phase 1 of that project will be commissioning in this financial year. And we are also looking forward many such opportunities across the country.
Suresh, appreciate your time and wish you and everybody at Adani Total a wonderful year ahead, and festival greetings from everyone from ET Now.
Thank you very much for inviting Adani Total Gas once again. Thank you.
Let's take a break with the news that markets are just stuck in a very narrow, well-defined range. Asia is looking okay. So we are not like off center, pretty much in and around what the 19,000 mark is. But the bias from the day's high has come to day's low now.